Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So, in this video, I just want to reiterate that one of the reasons I love the velocity banking strategy so much is because it's so simple. And sometimes I'm amazed how people just kind of overcomplicate this, right? So, my home equity line of credit statement came out today. I posted in the community feed, right? So, my previous balance was $37,000. And then guess what? Whenever money comes into my checking account, I dump it into that home equity line of credit. And then whenever I have expenses, I take them out of the home equity line of credit, right? And as you can see here, the new balance is 28,000. Yeah, we do have to spend a little bit of money or on interest charges for that home equity line of credit. But you know what? If it makes my life simpler and it saves me a lot of money in the end, I think it's worth it, right? And it's easy. Paycheck into line of credit. You can see that right here. That's what this payments credits are for. Expenses out, and then your balance will go down by your cash flow. Boom. You see how easy that was? Oh my goodness, I didn't even have to think about it. And I'm just going to show you one more time and reiterate how simple it is. And all you need to do velocity banking is do two things, right? Number one is the budget, right, which you've already done. And I love using this scenario, right, the 10 credit card scenario, because a lot of people, they make good money, $7,000 a month. Like, oh my goodness, I don't know how to manage my cash flow, and I somehow got 10 credit cards that equal up to $111,000 of debt, right? I got a mortgage too, but we'll figure that out in another video. But budget, and then line of credit as our main operating account. So line of credit kind of like this. So you might have a lot of home equity, and you could use that kind of like a credit card. Basically, it's just based on the value of your home minus the debts that you owe that are tied to the home, like a mortgage, right? And usually the banks are willing to lend you about 80% of that. And let's just assume this person has a ton of equity, right? And the bank says, okay, you're going to get a home equity line of credit for up to a limit of $150,000, right? And so now what we're going to do is we're going to just do this over and over again because that's how you get good at anything, including velocity banking. We're going to tweak our behavior, same income, but guess what? Zero savings. A lot of people are afraid of that. A lot of people are afraid of zero savings, but guess what? I don't have any savings because every time money comes in to that checking account, bam, it's going into that line of credit because it does two things. Okay, it does two things. It satisfies the minimum monthly payment and it minimizes the interest because the interest is calculated by the average daily balance, right? So when you lower that balance as much as possible and then you take out your expenses accordingly, it's going to be at the most, what do you call it, the lowest possible, right? Or hopefully the lowest possible if you don't screw up. All right, so now this is what we're going to do. So someone's making only $7,000, great income, only has $330 in savings left over, and most people would freak out saying this, oh my goodness, I'm so irresponsible, credit card debt, world's over, right? So this is what we're going to do, okay? This is what we're going to do. We're going to use our line of credit as our main operating account, meaning we're going to dump our entire paycheck into that line of credit and then take our expenses out. And the balance is going to go down by our cash flow plus the interest. So you see the interest here, and then you see our cash flow plus the interest, and that's the new balance, right? So now let's calculate our cash flow. C2 minus C3. It's not 330 yet because this is what we're going to do. We're going to do some debt transfer to increase our cash flow and make this as our main operating account. So if we count all of this right here, it's $111,000 of credit card debt. So let's go ahead and put a 111000 right here, and we'll call this month 0. And so now let's go ahead and move all that debt, and guess what happens to these payments? Oh my goodness. We went from 330 to 3,800 without making more money. Cheat code, right? Cheat code in real life with debt payoff. Again, paycheck into line of credit, expenses out. Paycheck into line of credit, expenses out. Doesn't mean you can't use credit cards. There is a trick of using both credit cards and a line of credit for this. I'm not going to explain it, but I do use that trick. But again, the whole premise is the same. Paycheck in, expenses out, your balance is going to go down by your cash flow plus the interest. I mean, take a look at this here. Cash flow plus this interest is your new balance. Okay? Boom, boom, boom. Can I get a boom in the chat? All right, or in the comments. All right. So now let's go ahead and I'm just going to quickly calculate this, right? So to get the new balance of every month, it's the previous month's balance plus the previous month's interest minus our cash flow. 3,800. Okay, 3,800. And now let's go ahead and calculate the average daily balance or estimate it using the average function, right? So the average or the midpoint, we're going to estimate and say the average daily balance was the midpoint here, is about $109,000. And then we multiply it by the interest rate, 0.1. Okay, now that's the annual interest, right? The estimated annual interest. So what we're going to do is get the monthly interest and then divide by 12. Okay, so now what we do is just simply copy and paste. Copy and paste the formula. Oh my goodness, payoff was so easy, right? So now we're at 34 months. 34 months, okay? And how much is 34 months? So 34 divided by 12, 2.8 years. So under 3 years, we paid off $111,000 of credit card debt. And people freak out, "Oh my goodness, credit card debt. Like I'm so screwed." It's the ones that really kill your cash flow. Well, I wouldn't say kill your cash flow, but ones that people have trouble with, especially these amortized loans. And I'll tell you why. And this is just mainly from consumer behavior, right? Why does it? I don't know if you're aware about the statistics about how long it takes the average person to pay off a 30-year loan. Like theoretically, it should just be a 30-year loan, right? But what happens is that every 5 to 7 years, a person either resells their home, meaning that they got to get a new loan. So essentially, think about like, oh, you paid 5 years, and then you got to get a new loan. That's essentially like a 35-year loan, right? Or you refinance and it's like the bank sends you a letter, hey, guess what? You could get a lower monthly payment and take some cash out of your home because you got some equity. And so on average, it takes about 52 years to pay off a mortgage, right? It's crazy. And the reason that people can't do that is because mortgages are one way, like paid off early, is because mortgages are one-way streets. You overpay them, it's hard to get that money out. Okay. But you can use a line of credit to pay off your mortgage early, which I'll explain in another video. But let's just kind of write this as our milestone and a reason to celebrate. So let's go ahead here. And we paid off $111,000 of debt in 2.8 years. That is reason to celebrate. Isn't your mind blown? My mind is super blown. Shmika. All right. So now 2.8 years. And so what about you? Maybe you should practice this scenario. So sometimes they say like, and maybe this might be a bad example, that people who don't have that much money and fly first class all the time, the reason why they do that is because it's like if you play the part, and I'm not recommending that you actually do this, you'll eventually get there. Like I heard of this guy, I don't remember who exactly it was, but I remember the story about like he wasn't making that much money, but every time he traveled, he made first class. He always traveled first class because like I'm already there, and then eventually got to a point where like he could afford first class because he imagined he was already there. So what's the point of this story? So you might be looking at this and saying, "Oh my goodness, $7,000 of income! I don't make anywhere near that," and like who would get into that much, make that much money and be broke, right? And trust me, there are tons of people who are in that situation. If you ever look at the statistics, 50% of Americans are paycheck to paycheck, more than six figures, right? And so, if you're not making that much money, I still encourage you just to go through these scenarios, even at higher incomes, because once you reach that income level, you'll be like, oh my goodness, like I'm not going to be in this crazy amount of debt and I'm able to manage my cash flow because I can understand what to do at those higher and higher income levels, right? And so that's kind of like my point that even if this doesn't apply to you, just practice these scenarios over and over again. Maybe you got like 10 or 11 credit cards. You could find out the monthly payment by going to bankrate.com and looking for a minimum monthly payment calculator and just imagine that you're making this income. Once upon a time, I was making like 20 grand a year, and I say this all the time in my videos now because sometimes I got to repeat it because I'm gonna forget because it doesn't feel real to me. Because I look at my HELOC, right? I put this much into my HELOC, so when I say 20 grand a year, this is like 13 grand a month. Like, like I still am the same person. So again, a lot of people think like money changes you, but really money just magnifies who you are. That's all it does. It's an amplifier. All right. All right. So just another quick demo of velocity banking. I have, a ton of other videos in this channel going through everything, but I just want to re-emphasize again how easy it is in real life because again, paycheck into line of credit, expenses out, repeat over and over again. These finance charges are the interest, right? So paycheck into line of credit, expenses out, right? That's what the minus is, or paycheck in, expenses out plus the interest. Paycheck in, expenses out plus the interest. And next month we're just going to repeat the same scenario over and over and over again. So wasn't that easy? Oh my goodness, that was so easy. Like, and here's the best part, right? I always get fascinated by seeing this little tiny 330 number and like, oh my goodness, the world is going to end to explode to 3,800 without making more money, right? Like, oh my goodness, I didn't have to do anything to make more money because I switched, and this is the most important part, my operating account. My operating account isn't my checking account, it's my line of credit. My main operating account is my line of credit because I'm going to put my entire paycheck in that line of credit, take my expenses out, and then rinse and repeat over and over and over and over again until we got that zero payoff. Beautiful. All right, well, this is Korean Atlanta Mentorship. Just another quick review of Velocity Banking. If you're interested in joining our group and learning not only Velocity Banking, because here's the thing, there's a world after debt payoff, right? Maybe you want to learn about real estate investing. I don't know. But if you want to learn about with us, go ahead and click the Google form link below. And other than that, have a great day, and we'll see you on the next video.